Hello viewers, welcome to Om Financial Services YouTube channel. First of all, wish you all a very happy new year. Today we'll be discussing about active and passive funds. But before we start, I would like to read out the disclaimer as usual. The video contains my personal views based on my experience. This video is for educational purpose only. Viewer must consult their investment advisor or financial planner for any changes to portfolio or any investment decision. I am not making any recommendation through this video. Good. So as usual, we will try to keep it mixed between Hindi and English so that all sets of users or viewers should get the idea about it. So what is basically an active fund? We have to start from that. So active fund is nothing but the mutual fund that we understand so far, the erstwhile mutual funds that we know for last 20-25 years. Those are basically active funds. So what happens in active fund? Active funds are basically managed by a professional manager based on a predefined philosophy of that particular fund, right? So we know the different AMCs that are operating in India. A couple of them is basically HDFC, ICICI Mutual Fund, ICICI Prudential Mutual Fund, sorry about that. We have like Nippon India, which was erstwhile the Reliance mutual funds. They all have various schemes, and within that schemes they have different managers. So for example, let's say there is an XYZ company who has a large cap fund which is basically investing in all large caps and has a mandate of investing in the stocks of Nifty 50. So their underlying comparative index or benchmark index is Nifty 50. Now Nifty 50 has 51, 52 stocks, and let's say one of them is Reliance India Limited, and we know that Reliance is doing very good, but a fund manager of this XYZ mutual fund may decide based on his own understanding of the market and the strategy that Reliance has given a good run in last 2 years and there is not much scope available for further upside. So he might decide that instead of 15%, he might want to allocate only 5% of the capital and allocate that rest of the 10% to any other beaten down stock. Let's say for example Sun Pharma or Bharti Airtel or something like that. So that particular selection of the stocks and the allocation of fund is in the hand of that fund manager. What he does is, based on the market conditions and movements and different market sentiments that are happening in the market, he decided to move money from one stock to another stock within that particular set of permissible stocks. He can also decide to hold some portion of that into the cash or diversify to certain mid cap funds or small cap stocks to just enhance the return. So the mandate with the fund manager is to generate a return which is beating the returns coming from the index. So let's say in last 5 years or 1 year, Nifty has given a 10% return. So this being a competitive world, the mutual fund manager will try to beat the Nifty and generate a alpha returns, that is basically 2%, 3% or even more than that, so that they can market it saying that we have beaten the Nifty by so and so percentage. So if you understand so far, active funds are nothing but the mutual funds which are actively managed by a fund manager, and there is no limitation on him or any binding on him that how much percentage he can allocate to those stocks once the mandate is decided that he want to go for a equity large cap. Similarly, the passive funds are basically very similar to the mutual funds. It is basically a collection of various stocks, but the main difference is that the stocks are based on the constituents or the constitution of the index. So I'll take an example of Nifty, for example. You might see XYZ Nifty Bees or XYZ Nifty ETF, right? What is this? This basically is that it exactly replicates the constituent of index. So this XYZ Nifty fund will have a reliance in the quantity exactly equal to the allocation of reliance in the Nifty index. So currently it might be 13%, for example. Similarly, Infosys might have an allocation of 7% in Nifty. Exactly same allocation should be there for Infosys in that XYZ Nifty fund. Whenever there is a change in index constituents, let's say for example NSE decides to reallocate certain percentage from Reliance to let's say any other new stock, the ETF or a index fund has to automatically end of the day change that allocation, right? So the key here is that entire management of the constituents and the allocation to those constituents is automatic. All the management of that fund is done by a computer or an algorithm. There is no manual intervention, right? That's why it is called passive fund, since it is not managed by someone, right? And it is based on certain underlying index. We call it a passive fund. So I hope the difference between active fund and passive fund is clear here. Active fund is nothing but the mutual funds that we know, the historical mutual funds, and passive funds is something not exactly new, but recently it is catching up the attention, right? So what are the pros and cons of this both, right? The active funds and the passive fund. So pros of active fund is investments are actively managed by dedicated fund, right? So what happens is, if the fund manager is good, you will see a handsome returns because he will be timing the market perfectly. He will be judging the risk perfectly so that he allocates higher percentage to the high growth stock with less risk, and lower fund to high risk, low return kind of thing. So allocation is perfect, so that, and the timing is perfect so that your returns are very good. The other thing is that best stocks are selected before their growth is visible to the world. So if the fund manager is intelligent and smart and he has a good study, he will pick up the stocks with a, not only a good background, but who has a higher probability of higher chances of giving a good returns, right? It will have more stocks and diversification would be higher. So in passive funds there might be only 50 stocks, but a diversified large cap fund might have 180 stocks. Some of them might have percentage of 0.1%. Some of them might have a allocation of, let's say, 10%. So because of the size of the fund, as the size of the fund grows, there will be more stocks, hence the diversification is better. And on top of that, the fund manager, we are discussing the previous slide, the fund manager can decide which stocks he want for what allocation. Of course, within the permissible, the strategy and the philosophy of that fund, which is mandated by SEBI, but fund manager has the right to choose those funds. But on the downside, active management funds leads to higher degree of churning, right? Because they want to manage the alpha, give you better return. They will be frequently buying and selling the stocks. And while doing this, they might incur a heavy transactional cost. And that cost basically will be charged to your fund. So you might generate a 10 rupees more profit, but end up in saving, end up in spending 4 rupees to, for those transactions. Fund manager can go wrong. If he goes wrong, definitely fund will be underperforming. This third one is very important. Mutual funds are open-ended, right? They have to cater to the redemption request of any subscriber at any time. So they have to always maintain a cash in their portfolio so that they can always, give the redemption request. What basically does is the investment happening into the market is reduced by that cash maintained in the balance. So let's say out of 100 rupees, the fund manager might invest 80 rupees only into the market, and 20 rupees he can keep it as a buffer for the redemptions. So this basically reduces your return or the yield that you might get on the funds. Another important aspect is the performance of the fund to a higher degree depends upon the capability of the fund manager. If that fund manager leaves the fund, there is a pretty good chances that the fund might underperform under the new management, right? Similarly, with passive funds, the pros are fund management is automatic. So there is no human. The person comes in, goes in, fund manager comes in, goes in, doesn't matter. Once the index constituents and its allocation is decided, index funds and ETF has to mirror that. Since it is automatic, no manual intervention is there, no frequent churning is there, the cost of maintenance and the transaction cost goes down drastically. And that is basically our saving. It means our more and more portion of our money is getting invested into the market instead of being paid as a fees to the brokers, fees to the employees, the infrastructure cost, the rents of the building and bills of the ACs and all those things. your higher portion of your investment capital is getting into the investment. So even if the percentage return is less, the yield is higher, right? So instead of getting 10% on 80 rupees, I am getting 8% on 100 rupees, right? Or even if I get a 0.5% more, my yield is getting better. The most important thing is that if there is a big intraday movement, let's say somewhere some election happens and market falls by 1000 point early in the morning, and by end of the day it recovers by 900 point, if you buy a mutual fund next day, you will get a benefit of hardly 100 points. But ETF and index funds are traded on the exchange. So if there is a big fall in the market, during the day you can buy that fund at a very low prices. This is the biggest difference between the index fund and the mutual funds, and that's why it has become my first choice for investing into the mutual funds. I always prefer index fund. We will discuss that in later. And because of this ability to trade on exchanges during the open market hours, we can take a benefit of intraday pricing movements. But it has its drawbacks also, right? So most of the companies included may have already picked their significance. So let's we take again example of Nifty. What does Nifty says? Top 50 companies by market cap in India, right? So if an XYZ company today is trading at only 100 crore profile, for it to become a part of that Nifty and consequently the part of Nifty index fund, it has to be like 700 crore or 800 crore company, and then only at that time it will become a part of Nifty index. Investing in index will make us to lose the opportunity of investing in the stock that has a potential to become a multi-bagger or a large cap 7 years back, right? That is a drawback of it. There is always a chance of tracking error. What does this mean is basically, let's say for example, today there is a 14% allocation of Reliance in Nifty or 13%, and the fund that we are investing fails to mimic the exact percentage, even if by say 0.1%, that tracking error is always there. It is not very significant, but yes, I mean it has it is a significant factor that we need to consider while investing into the index fund. Another important drawback is that since these index funds are catching up recently, there is not a huge trading volume. Sometimes somebody wants to sell at 100 rupees and somebody wants to buy at 110 rupees. There is a huge difference between the ask price and bid price. So if you want to sell something, though current price might look as 110, but if you buy it or sell it, you might end up in selling at only 100 rupees. So you need to be very patient while transacting with the ETFs, especially with anything else than Nifties. Certain Nifty index funds have a considerably good volume, but other than that, few index funds are very less on trading volumes. So exiting and entering might be little cumbersome or prone to errors actually. Secondly, if we go and find out how many large cap mutual funds are there in the market, you will get at least 500. But if you try to find out a large cap equity traded, exchange traded fund or index fund, you will hardly get 2 or 3 of them. So choice of funds is very limited. And as I said above also, we might miss a chance of significant growth because that one potential company may not be the part of index when you want to invest into the index fund. So if you consider all these pros and cons, right, now the question comes to mind is, what should I as an investor do, right? How do I decide? Because both have pros, both have cons. There are some good things into index fund, while there are some drawbacks in the mutual funds, this thing. So should I go all out on index fund, passive funds and totally avoid actively managed fund? Right? The answer is no. Okay. So should I only invest in then actively managed mutual fund and ignore the index passive funds? Again, the answer is totally no. So then what should I do? You are given this 15 minutes presentation about active funds and passive funds, and to both the questions we are saying no, right? So answer is very simple. Since both of them have a some pros and cons, some good things and some not so good things. We have to decide what we want to do as an investor based on our risk profile, based on our intention or the goal of the investment, and also the time, your age, and all those things, right? So investor who is already in the accumulation phase, who has a accumulation phase of another 10 to 15 years, who has just started earning, has a surplus investment right now, surplus investable surplus right now, can choose for around 80% of his investable capital to go in active funds and 20% in index fund. And similarly, on the extreme side, if there is a person who is nearing his retirement or nearing the goals, he should lower down an exposure to the active funds and increase that allocation to the index fund. Now the question arises, why? Why should we do that, right? So if you understand the pros and cons that we have discussed in the last two sides, if we stay invested in active funds, on one side there is a potential for high growth, but since the allocation is concentrated and unknown, I will not say unknown, but it is changing, it's dynamic, and there is a room for error or a mistake happening from a fund manager, and he might allocate a wrong percentage to a wrong stock, and it can screw up your returns of the entire fund. So there is always a risk, right? But you cannot take your money and put in the fixed deposit and not get a good returns. So if you want to stay invested in the market, take the market returns, but reduce the risk on your portfolio. So you will move your majority of the portion of your portfolio to a passive funds. So that, okay, I may not get 17% and 18% of the return as some of the funds might offer, but my drawdown also will be considerably less. So I invest more when I am young. I have a more earning life cycle remaining into the active funds, and as I reach closer to my goals, I will move to the passive funds, right? So your time allocation, your strategy based on that. Then why should we at all invest in passive funds when it is giving all this kind of the drawbacks of not meeting the growth potential of the actively managed funds, right? So I think investing in index fund gives stability to your portfolio. Second, the returns might be less, but the yield is higher, right? And since it is automatically managed, it gives you a very long-term stability, right? You know that most of the stocks are falling, even then the Nifty is going up. It means there is some smart allocation is happening behind the scene, which is trying to keep index afloat and give you a inflation beating returns. So if you are early in the stage, you can have a lower percentage to the index fund, but that lower percentage will keep your entire portfolio stable, right? Your beta of your portfolio will be less. Similarly, when you are reaching your retirement age or nearing to your goals, if you move your majority of the funds to the index funds, again the beta will be low of your portfolio, so that when you are nearing the goals, there will be lesser fluctuations in your portfolio, right? So one solution is basically, as you reach closer to the goal, you move your money from the market, from the equities, to a debt fund or to a liquid fund, or put it into the FD. But again, there you are basically lowering down your market returns. Index fund gives any investor a very good choice of reducing the risk, yet stay invested into the market by having a good allocation to the index fund. So I hope this was helpful. It will help you to make some choices in designing your portfolio. As again, I would like to thank you for watching this video. Also, if you can like this video and subscribe to your channel, it will help us to, it will serve as a good motivation for us. Lot of people has called me after my previous videos. We had a good discussion with the people. I tried to help them solve their queries. Again, I got a chance to learn new things from them. So I will again urge, if anybody needs any help, please feel free to call me for any guidance. I don't charge for telephonic call. It is a two-way communication. I also learn few things from you guys. Good. So I will end this video here. Hope it was helpful to you guys. Thank you very much.